Good morning, traders. This is Matt with Newbie-Trader.com, and this is your weekly gap wrap for the last week of July 2016. And I not only want to go through the high probability gap trades for the week and what happened there, but we've been in a consolidation period, and I wanted to kind of do a little bit of education this week and talk to you about higher time frame analysis and show you how you can use that to help aid in your trading, especially when you're in an environment, a sideways market like we've seen this last week. Obviously, looking at the week here, going back to Monday, you can see we've been in a completely sideways movement. We're looking at the S&P here, and if you look, you see areas of gray across the screen. That is the overnight session, and then to the immediate right side of the gray, you'll see a green vertical rectangle. It's kind of a lime-colored green. Well, that is your high probability gap range for each day. And basically what we look at, if the market opens in that high probability range, we have about a 94% chance of the market hitting the half gap during that trading session. The half gap is this gold dashed line, and the green horizontal line you see there, that's the actual open, and then the red horizontal lines, the thicker one is the 4 o'clock close, the skinnier one is the 4:15 close. And so what we do, we look to trade towards that half gap when we get an opportunity on the open by entering on a shorter time frame. And so each one of these days, the market opened and actually traded up and actually filled its half gap each one of these days. But you would expect that in a sideways market. So a lot of times there wasn't a whole lot to gain from trading the gap because we opened up real close to where the gap was. Wednesday was a pretty good day. You can see we opened up near the upper edge of its range, and it traded all the way across the range, and you easily filled the gap and full gap. Thursday, not much room there. Friday, there was not much room. So there wasn't a whole lot to be gained from trading the half gap this week. So I want to go ahead and show you kind of inside the trading room and kind of what we look at. And the bottom left-hand chart, this is a higher time frame chart on the ES. And we keep that running just to kind of keep our perspective. Let me just blow that up for you. And you can see this is using our NT Renko candle. This happens to be a 20 Renko candle. Now, when we're actually following our auto signal tool, our ultimate fractal tool for the S&P, we actually trade off of a 4 Renko candle. So the time frame we're looking at here, just to kind of keep a perspective on the market, this would be 5 times larger than our normal time frame. Now, if you're one that likes to trade time-based charts, maybe you trade off of a 5-minute chart, but maybe you're monitoring a 30-minute or a 60-minute or even a daily chart for that higher time frame. And the whole concept and the whole reason that I like to look at higher time frames is because what you're doing on the shortest time frame or the time frame that you're trading on, ideally you want to take trades that are in the same relationship to the higher time frame. So let's just take this chart and go back a few weeks. Now, looking at this chart, again, this is a 5x factor over what we trade. This goes all the way back to like the 23rd of June. Okay, so you're looking at over a month's plus worth of data here from a calendar standpoint. And this is a Renko chart, so it's only showing you price action, so time's really not relevant. But we do look back 2 weeks, and you can see we have a volume profile over here on the left. Now, looking at the last 2 weeks of data and just taking the value area high of the volume profile, we got a line at about 2169. You take the value area low, and that's 2158. So basically what this is saying, in the last 2 weeks, we've been in about 11-point range from high to low. And you can see the market's obviously going sideways. And the previous chart we were looking at, you saw the market was going sideways. But if we go back more than a couple of weeks, you can see, okay, we had some real areas of trend. We kind of stepped to the downside, and then towards the end of June, we made a couple stair steps up, and then from the last 2 weeks of July, we've been just sideways. So in this area of expansion to the upside, you want to obviously be focusing on long trades, and on these pullbacks or these moves to the downside, you want to be focusing on short trades on your shortest time frame. And in the consolidation phase that we're in now, or this could even be a bigger picture rounded top, during this consolidation we've been in the last 2 weeks, you want to focus on trading outside in or taking trades where you're trading towards those edges. Okay, so now that being said, let's go ahead and jump over to our shorter time frame chart, and I'm going to show you, we'll just look at Friday's data, and I put some horizontal lines on here to represent the 2169 area, which is that value area high on the last 2 weeks. I put one down here at 2158, and that was the value area low. Okay, so here's Friday's open, and here's the high probability gap bar again. You can see we opened and we pushed up, and we actually had a signal long. It's not marked here, but basically right at the open, you can see a signal long. They went up to our red line, and that is the gap. So we opened inside the high probability gap range. They went immediately up to the gap. You could have taken profit right there at that gap and been done with that move to the upside. Now they rotated off of the gap and they pushed down, and we got a signal short. Now this signal short was at 2160, and you have to ask yourself, and it's based on your risk reward tolerance, but you know that the lower edge for the last 2 weeks is running around 2158. So you get a short signal and you have a take profit area at 2168. You have 2 points, 2 ES points, that would be the equivalent of $100 per contract, opportunity to the downside, but you also know you're in a sideways market and you can rotate right back up to this area of value, which happens to be around 63, or the open up around the prior gap fill. So this wasn't a great reward to risk trade, and if you hung back and didn't take this trade for 2 points to the downside, I would not fault you for that at all. Again, because you know that you're at the bottom of your range, and we expect the market to do a range rotation up to the higher point, 2169, based on what we've seen over the last 2 weeks. Now, of course, this market can break out to the upside and it can break down. So what we had our key buyer zone down here. We thought the buyers were going to step in underneath 58. We thought they'd be around 56. They didn't. They made it down to 57, 57 and a quarter, and the market started to bounce. You had a long signal here. Now this is your central pivot band, so we expect the market, this beige colored horizontal block, that's kind of where we think the market is going to pivot around on this given day, and we think the sellers are going to step in up at this red bar. So we got a signal long right at this pivot zone, so you might not have got in at 62, which would have been the entry. Had you got in at 62 and you took profits up here at 69, there was a 7-point opportunity based on the auto signal tool. But more than likely what you did, you waited for the signal at 62, got confirmation as they were pushing through this pivot zone, and we actually had what we call an extreme tips, which was a momentum indicator. That's this little white diamond you see here. So the market did start pushing up, and this one had a much better reward to risk opportunity because you had 7-point potential, and you only, if you go back to the swing low, you had about 4 points on the downside. So you were better than 1.5 to 1. So it was okay to get long here, and you might not even have tempted to go all the way to 69. You might have actually taken profit at our first sell zone. And in fact, you can see at that sell zone, the market did pivot a little bit and it kind of rotated here if you would have taken profits. But then there was another add to signal that came on at 67, right where those profits would have been taken, and then the market pushed up. And then the rest of the day we kind of chopped. Now what's interesting to note here, and we'll keep our eye on this moving into next week, and you should too, we have closed above the 69 area. And let's go back to our value chart perspective. But if you look at this longer, this close, it's kind of interesting. We're up near this upper edge, and we actually closed above it. But let me go ahead and delete these lines where I was marking the value area. I want you to pay attention here. Let's just actually zoom in. That might help matters out a little bit. But as we zoom in, look at what's going on this value zone. You can see we have a high volume node that's pretty much right in the middle of this range, but near this upper edge, we've been getting a lot of volume coming in. Now, that volume has been these reversal candles to push us down through the range previously, but with the close above in this high volume node, it could be an opportunity for them to start using this area near the upper edge as support. So right around 69 or whatever, or 67, 50, whatever this high volume node is exactly, that could be acting as support, and they've closed above it. So what I want to watch over the weekend open and then into next week, I want to see if they actually can start holding this. And this low volume node, this valley you see, that could be acting as support. So they could start developing volume above this upper node, and they might use this low volume node here as support. And if they do, we might get a consolidation and a push to the upside. However, if we continue sideways and we rotate back down, you'll just kind of stay in a sideways rotation. So as you can see, we're rotating between 69 and 58. We have to assume that rotation is going to continue, and you want to look at not getting chopped up in that environment. But if we do break out to the upside, we do have a volume node that they might use support. So if we break out and they start using that area as support and don't fall back within, then we might be building an opportunity to go higher. Otherwise, I'm thinking this looks more like a bigger picture rounded top, and there's more opportunity to the downside. So we'll have to wait and see next week to see how it unfolds. But that's how we like to use our higher time frame analysis to make our decisions on our shorter time frame as to whether to take the trade and what the opportunities are. So pay attention to it, trade in the direction of it, and when this market does start trending again, keep an eye on that higher time frame trend and take your shorter time frame trades in the direction of that trend. And it's like we like to say, it's much easier to swim with the current. So have a great weekend and good luck next week, and we'll talk to you soon. Thanks, and make it a great day.